Okay, so welcome back to the desk. We're going to start looking at our next driver now, which is inflation. And obviously, inflation is an important one for us. It's going to actually take up 4 videos of our endogenous driver analysis. So it does take up a big chunk of it. And it's important to us because inflation is actually, as we're going to find out when we go to the computer screen, something that is very, very important to have in a standard capitalist economy. And you'll often hear this in macroeconomics that a low and stable rate of inflation is very important to an overall healthy economy. And what do we mean by that? Well, if the rate of inflation is predictable, so prices are predictable, this creates a situation in an economy that provides a foundation that enables economies to grow at a stable rate of growth as well. So what we want in an ideal economy is a good level of nominal growth and a stable rate of inflation, so our real GDP growth, when we net out inflation, is predictable and always positive. And inflation itself, if it's high and volatile or negative and volatile, this is something that's moving away from what would be considered an ideal situation. And when we move on to the computer screen, we're going to find out that the ideal situation is historically what we would consider to be a normal situation and moves away from the norm. So big positives and big negatives away from the norm are actually in the significant minority. And when we have these moves, these big moves cause reactions. They cause reactions from central authorities. And the way we analyze the data is actually in exactly the same way as we did earlier with distributions, so statistical distributions with the money supply. And we go out into the world and we take the data and we do our thing as professional traders. We look to analyze the data and look for what's considered to be normal and what's abnormal, so we can really learn about this data and put it into a systematic overall process by scorecarding each of these drivers and scorecarding overall. Now we're going to be looking at the 2 areas of the private sector that we've touched upon earlier. We're going to be looking at consumers and we're going to be looking at businesses. So when it comes to inflation, the most important numbers to look at are the CPI and the PPI. And the CPI is the consumer price index and the PPI is the producer price index. So we're going to be looking at both of them. Both of these are actually split up into 2 areas. The CPI, which is CPI all items, including food and energy prices, and CPI excluding food and energy prices. So that's 2 within CPI. And in the PPI, PPI all items, including food and energy, and excluding food and energy. So that's 2 items in PPI. So 2 items in consumer inflation and 2 items in producer or business inflation. So let's go over to the computer screen, dig a little deeper into inflation, and move on with our next driver to build out our endogenous analysis. And I'll see you at the end of the video for a conclusion.
Okay, so welcome back to the computer screen. Let's kick off and start with inflation. As we discussed earlier on in the video series, there's 2 participants to the private sector, consumers and businesses. And with regard to inflation and deflation itself, what we need to look at, we need to actually look at both of them in order to gauge what's considered to be normal inflation or deflation and what is outside the bounds of normality. So what is abnormal? so we can actually scorecard accordingly. And what we're going to do is we're going to look at 4 different areas, 2 within consumers and 2 within businesses. So firstly, consumers, we're going to be looking at the following inflation stats. We'll be looking at the CPI, the Consumer Price Index, all items for all urban areas, which covers 89% of the population, and this number is seasonally adjusted. We're also going to be looking at the CPI Consumer Price Index, all items excluding food and energy prices for all urban areas, which again covers 89% of the population and is a seasonally adjusted number. So the only difference between these two numbers is the CPI X food and energy essentially strips out food and energy prices from the overall CPI index. For businesses, we're going to be looking at the following inflation stats. We'll be looking at the PPI, the Producer Price Index, for finished goods, seasonally adjusted. And we're going to be looking at the PPI finished goods, X food and energy, seasonally adjusted. So again, the finished goods PPI, excluding food and energy prices, excludes or strips out both food and energy items from the overall PPI number. So the analysis across the 4 areas is actually pretty similar. And what you'll find is that the PPI and also the CPI, they are monthly statistics, and they're released every month, and we'll have a look at the sources in a second. But with the PPI itself, the monthly stats that you see released every single month are actually PPI final demand stats, and the stats only go back to 2009. So we're not actually going to look at final demand. We're going to look much further back and look at the finished goods statistics, which are more useful to us. Okay, so we should start with the CPI, the Consumer Price Index, all items. The CPI stats, including food and energy, we have a code for them here, which is the generally accepted code when you're searching for inflation statistics. So the CPIA UCSL, so that's CPI stats including food and energy. The excluding food and energy, the code is CPIL FESL. So we'll be looking at that later. Both sets of stats are released monthly, so we get monthly inflation data on the schedule of the BLS, the Bureau of Labor Statistics, and the links are available here. We'll be going into those links a little bit later. The data for CPI all items is basically downloaded on the St. Louis Fed, but the stats do get released by the Bureau of Labor Statistics. The data for CPI, including food and energy, goes back as far as 1947, so it's pretty useful to us. And the way it's constructed is by taking the weighted averages of prices on a whole variety of items that are basically assigned weights, and representing those weights, that is their importance within each group. And the prices collected monthly come from 4,000 housing units and around 26,000 retail establishments across 87 urban areas in the United States. So it's very accurate data. And the changes in CPI, so inflation or deflation, are important to us in our analysis of the US and the purchasing power of the currency, the US dollar. But what we have to remember here is that the CPI is a coincident indicator. So it tells you what is basically happening in the economy now rather than in the future. So it's not as useful in predicting the future as useful as the leading indicators, because the CPI basically follows the leading indicators. However, it's still useful to know about this stuff because monetary authorities like the Fed are reactionary, as we've seen and interest rate policy and monetary policy, so even money supply, is based on inflationary expectations at the Fed. So obviously their policy will be affected. So we've got to take the inflation numbers, have a slightly lower importance in the back of our minds in terms of the CPI, PPI relative to leading indicators, but we still need to scorecard these because the Fed watches them like a hawk and basically reacts accordingly if CPI and PPI move outside their normal bounds. And you'll see a theme running here throughout our analysis of our drivers. You'll notice that we're looking at the inflation numbers in the same way as we looked at M2 money supply and previous drivers. We're looking at them by analyzing what is normal and what is abnormal. So what we do is we calculate a distribution of returns for inflationary numbers, so the CPI and PPI, in a similar way to the way we actually analyze the M2 money supply data. So we calculate the distribution of returns in order to discover what is considered to be normal inflation and what is considered to be abnormal inflation, so we can actually scorecard it properly. We then, similar to M2, take those monthly rates, we work out the percentage changes on a month-by-month basis, and we look at the last 12 months on a rolling basis. So we take a trailing 12-month number in order to gauge inflation or deflation in consumer prices, and we compare this number to the historical distribution of percentage changes, and we do that to see whether the current number is within the bounds of normality or outside the bounds of normality, i.e. an abnormal number.
Okay, so now we can take a look at this in a bit more detail by going over to the endogenous driver analysis spreadsheet. So if we come out of the presentation and go over to the CPI AUCSL sheet within the endogenous driver analysis file, if we come out of there for a second and go to the sources tab and look for inflation, so consumer and business inflation, and CPI AUCSL, and if we click on the link, that's going to take us to the St. Louis Fed and directly to the CPI all urban consumers, all items, so the CPI AUCSL. We can click on download data. This takes us straight to the spreadsheet, and this is the spreadsheet we want for the data going back all the way to 1947. If we come back into the endogenous driver sheet and head back over to the CPI tab, we can see the data has been cut and pasted here, and we have the date going up in months, so our monthly data, and we have the value of the CPI, so the monthly value of the CPI data, and we've worked out the percentage change month on month ourselves. We also have column D for real GDP, and our real GDP data is going back again to 1954.
So let's scroll back up to the top of the screen and start analyzing this data properly. Now you can see what we've done here is we've run a distribution of returns similar to previous examples in the video series, and you'll see that our intervals here are few. So compared to the M2 data, we have very few intervals, which makes it a lot easier to analyze the data. We have our statistics here with our ranges, our frequencies, and the probabilities of occurrences and the cumulative probabilities. We also have here our average of the entire data set, our mean number, and we have our averages and frequencies for both up and down moves and zero moves, and we also have our probability adjusted moves. We have our count, we have our descriptive statistics, and we have our distribution compared to a normal distribution. So the full analysis here is exactly the same as we've been applying both to currency returns and to M2 data. And we do this right across all four main inflation stats in the United States. And you can see here straight away that when we look at our distribution, there's a huge bias towards positive data points. So we have our zero number here and a huge bias towards positive data points. So we'll go into the analysis fully when we go back to the presentation in a second. Just over to the right here, you'll see we have our scorecard, which we will be looking at later when we go over to the presentation as well. And lower down, we have charts. So we have the CPI all items, seasonally adjusted 1954 to 2015 relative to GDP. So we're comparing this to GDP, and we have our average trend line here and our line of best fit. So you can see just by looking pictorially here that the positives are generally associated with positive GDP, and the negative data points are generally associated with negative GDP prints. And we've zoomed in on this chart to recent times. So we're now looking here at the same chart, but zoomed in for the period 2005 to 2015. And we have the same analysis with the CPI data points in blue, the GDP data points in red, our general average trend, so the average being the normal situation, and that constitutes a line of best fit across the two data points. And you can see that generally speaking, negative data points from the CPI are generally coupled with moves in negative GDP, and positive data points are generally coupled with moves that are positive in GDP. So if we head over back to the presentation, obviously again in your own time, you can go through all of these statistics, practice applying the same method of running distributions, then get to the point where you can actually interpret the numbers. So let's go over back to the presentation and start trying to decipher what these numbers really mean. Okay, so let's actually take a look at the numbers and see what we discover here. What we've got here is on the left hand side we have our histogram that we saw in the spreadsheet, and as a reminder we have obviously a big skew towards positive data points across the whole data set. We have our average, so the average mean of the entire data set, and we have the positive, negative and zero or flat moves in the CPI. And we have our average move up and down. We have our frequencies across the distribution and how this is split up. And we have our probability adjusted moves in the CPI. So what we're trying to do here is learn what is in the normal bounds and what is outside the bounds of normality. So the distribution allows us to do this, and obviously we discover straight away that there's a lot more positive data points. And when we analyze positive versus negative data points, what we realize is that monthly increases in the CPI throughout history have outpaced negatives by a factor of 7.25 to 1, which is obviously a huge difference. The long-term monthly average rate of inflation in the US is confirmed to be 0.294%, whilst the average inflationary month when we have a positive month is 0.383%, and the average deflationary month in the CPI is 0.229%. When we probability adjust the up and down moves across the frequencies, the probability adjusted monthly inflation number is again around 0.3, so similar to the mean. It is 0.320% on average for the up months, and the probability adjusted deflation number is minus 0.026% on average for the down months. So what we're starting to see here is that if the mean is positive and positives outpace negatives by a factor of 7.25 to 1, what we're starting to realize is that inflation is actually completely normal. Now, what about if we look at the standard deviation analysis? Well, one standard deviation of the sample is 0.35%. In the upper bound, one standard deviation is 0.65%, and in the lower bound, one standard deviation is minus 0.06%. And this occurs 78% of months. So 78% of months fall between these values, and that's compared to a normal distribution where one standard deviation would equal 68.2% of the sample. So basically monthly CPI all items, so inflation and deflation of consumers, all items in the US, historically the distribution is peakier and has very few but very large tails when compared to a normal distribution. And obviously we've seen this type of pattern before when we looked at the M2 money supply. Overall, what you're actually starting to learn here is the distribution of returns in asset prices and macroeconomics. Overall, what you're going to see is that they're not fully representative of normal distributions, as Chris Quill pointed out in earlier videos. So let's try and put all this together. So given that the one standard deviation was 78%, so let's approximate to 80% of times, the one standard deviation move 80% of times is 0.35%. So that basically is our normal bound. This basically means that 20% of the time there are going to be shocks, so significant inflationary pressures and or significant deflationary pressures. However, in all cases, the inflationary pressures are going to outnumber deflationary pressures by a factor of around 7 to 1. So, as alluded to earlier, it's pretty obvious that inflation is totally normal in the United States. And in fact, it's totally required. We'll go back to this again. Right at the beginning of the video series, we did mention that this would be as much a lesson in macroeconomics as it is learning how to trade Forex properly. Well, this is exactly what we mean by that again. What we're learning about here is actually how capitalism works in the broader sense, because increasing prices, inflation, is basically the gas that fuels the engine of economic GDP growth. So increasing real GDP growth and inflation basically go hand in hand. So nominal GDP growth, so GDP growth that's not adjusted for inflation, causes prices to rise. However, inflation has to be kept under control, so under a target rate, in order to obtain real GDP growth, so growth after an adjustment for inflation. And in a classic capitalist model, a low and stable inflation rate is very much preferred to a high and volatile rate, or even deflation itself, which is the killer to growth. So inflation is like a lubricant system to the capitalist system, and it's completely normal. In fact, inflation is absolutely necessary to enable economic growth. Now, in the US, the Fed targets around 2% inflation at any one time. And from the stats above, it's pretty evident, going back all the way to 1947, that they're prepared to do anything in order to avoid deflation. Because when we look at the stats, monthly deflation, the negatives in the data set, only occurs in about 11% of the count, so 11% of months. So deflation is significantly in the minority. So from all the stuff that we've learned about the CPI from the numbers and how it behaves in the past, how do we actually go about scorecarding this? Well, on the sliding scale, we obviously have to take into account that inflation is completely normal. So we tend to not score highly for normal rates of inflation and normal rates of GDP growth. If there is inflation, we will tend to have a short currency bias, but when it's within the normal bounds, we don't assign a high score to it. Now, a major short bias score in the US dollar will occur when there's significant deflation, because history tells us that this only occurs in 11% of months. So whenever monthly deflation occurs in the US, this is usually during GDP contraction, and the Fed tends to act quickly. Now you can have a look at this in the spreadsheet. So if you filter for values for less than 0 in the spreadsheet, you're going to find that there's 94 cases of deflation since records began in 1947. And they tend to come in periods of GDP contraction, and they tend to come in clusters. And when deflation begins creeping and it's small, we tend to have a long currency bias. And as just mentioned, when deflation is extreme, a short currency bias predicting inflation in the future, because it's apparent that the Fed will act sooner rather than later. Now, if we look at the other side of the scale, the positive side of the scale, if you go into the spreadsheet and you filter for values of greater than 1%, so significant inflation, you're going to find that there's 34 cases of monthly CPI above 1% since the records began in 1947. And you'll see that many of these cases occurred in the period 1973 to 1974. Now, this was due to the oil price shock of the period, in which oil rallied from $3 to $12, so going up 300% in price. And that kind of makes sense because we're looking at the CPI all items here, and all items includes food and energy prices. So when we look at extreme inflationary pressures, they tend to occur when there's significant growth in the economy, or at the end of cycles prior to a slowdown, so prior to deflation, or when the Fed acts aggressively to spur inflation in a crisis. And this adds fuel to our argument that in periods of severe deflation, we have to have a short currency bias. On the extreme inflationary moves, we scorecard similar to M2. We tend to have a short currency bias on extreme inflationary moves. So we looked at M2 earlier, and as we went up the positive scale, our conviction or our scoring went higher, the higher inflation we got. And that's because we get more and more conviction in our short currency bias, the more inflation we have. Okay, so let's have a look at this pictorially and try to understand what's going on here. So if we look at the chart that we looked at in the spreadsheet, and by the way, you obviously have access to the spreadsheet now. You can go in there, look at the chart, click on the data, have a look at where the data is coming from, where it's being referenced from, and also when you go to get your monthly CPI stats from the St. Louis Fed website, you can obviously update this spreadsheet by putting the data in the latest row right at the bottom of the data set, and then go back to the charts. And if you right mouse and go into the edit formulas function on select data, you'll be able to update the formulas in there to include the latest row, and you'll see the data add to the chart in the far right hand corner, so the latest data will update. So what are we actually looking at here? Well, CPI, all items, all urban areas, seasonally adjusted all the way back to 1954 to present day, and we're looking at that relative to real GDP growth. So on the left hand side we have our CPI numbers, and on the right hand side we have our real GDP numbers, all going back to 1954. In the blue we have the monthly CPI change in percentage terms, and in red we have the real GDP percentage change annualized, but on a quarterly basis, so quarterly numbers annualized. And on the bottom axis we see going all the way back 1954 all the way up to present day. So what are we looking at here? Well, we've drawn a mean trend line, so the average of all the data for CPI, and we can see this comes to around 0.3%. So that fits our data from earlier that we looked at in the statistical analysis, and we see that 0.3% is equivalent to around 1 to 1.5% GDP growth. And this is how we start to build out our scorecards. If we look at a more recent time period, so 2005 to 2015, so it's just exactly the same data and chart, but then we filter or cut out all the data before 2005. So we zoom in on this period, 2005 to 2015, and all you have to do that is basically change the dates on the x-axis. And we can see we have a similar situation here. We are lying around an average of 0.3% in monthly percentage change in CPI, and this equates to around a 1 to 1.5% GDP growth. So we're building our scorecards based on what is normal and what is abnormal, and we know from the data that inflation is completely normal and 0.3% is also completely normal, and that means that around 1% of GDP growth is also completely normal. That's what that level of inflation, 0.3%, is associated with. 0.3% is associated with a 1% GDP growth in the United States. So what happens here to our scorecard when we construct it and put it all together? Well, we have the CPI all items here. We start at 0. We start scoring at 0.3 because on the positive scale this is completely normal, and we can see 0.3 equates to 1% GDP growth. On the CPI scale we go up in increments of 0.1 all the way up to 1.4%. And on the decreasing side of the scale, so deflation, we decrease in units of minus 0.1. And the levels of GDP across the data that is associated with each level of CPI, both in the positive and the negative, are input into the table, and we score accordingly. So how do we scorecard this? Well, during benign to within the extremes, so that what we would consider the normal range of inflation, so one standard deviation, we basically have 2 areas, and this sort of format is now going to look familiar to you. So when deflation occurs, so this is the minor deflation that we talked about earlier, we have a long currency bias. The slowdown is usually an occurrence of tighter monetary policy or due to a negative economic shock like an oil collapse, which has happened recently, the housing crisis of 2008, terrorist attacks in 2001, stock market collapse in 2000. If you look throughout history, you'll see what periods of negative GDP growth, what time they actually came. what these periods are actually associated with in the CPI, and vice versa. The future policy is basically to loosen on the extreme moves. So we get a reaction from the Fed when we get extreme moves in the CPI. So when deflation is creeping, we have a long currency bias. When deflation in terms of magnitude is extreme, we have a short currency bias. And when we look at the opposite side of the scale, so when inflation occurs, we tend to have a short currency bias. So when we have it within the normal range, we have a 0 for normality, for complete normality, but then we start to have a short currency bias with low scoring getting higher. So when inflation occurs in the normal range, we assign 0, but then we have a short currency bias when it comes outside the bounds of normality. And high growth, so high growth here is usually an occurrence of normal or loose monetary policy, and future policy is to tighten or normalize after extreme increases unless there's a crisis. So we look here at our scorecard and we see that we go up on the scale of conviction to where, for example, we have a 1% move in the CPI. So very inflationary levels where we only saw, I think, 36 cases in history. And equivalent to this or associated with this number is around 5% GDP growth, which is obviously extremely high, which means inflation and growth is getting out of control. And then you can see that as we get to very extreme levels of inflation, our conviction comes down because we believe that the Fed will actually act, and we possibly have to even jump from here if they do back to lower levels or even in the deflationary zone because we're probably likely to get a slowdown in these numbers. So let's take a closer look at this. So looking at this a little bit more closely, the closer that we get to extreme deflation, the higher the likelihood of future loosening monetary policy from the Fed. And the closer we get to extreme inflation, the higher the likelihood of future tightening or normalizing policy from the Fed. Unless there's a crisis in which you'll see aggressive loosening policy. This is why we have a neutral bias, then a short bias all the way up the positive side of our CPI scale here. And prices, we discovered, spend most of their time inflating. So the positive data points in our data set make up 85% of the count. So 85% of the time, prices are inflating and at a predictable and normalized rate of around 0.3% to 0.4% a month. And that's why we score lower down on the positive side a short bias, which is low on the scale, because it's completely normal. When deflation occurs 15% of the time, and we're counting 0 as a deflationary case here, it is more than likely that the Fed is reacting to overheating in order to deflate. It's not a common occurrence, which is why we score quite aggressively for a long bias in deflationary periods and relative to a short currency bias during inflationary periods. Now, one interesting point here is if you count the scorecard occurrences, there's 15 in total. 10 are inflationary short currency bias, 3 are deflationary long currency bias, and 2 are neutral. So we're looking at our kind of 80-20 rule here, where 80% of the time we're looking at tending towards a short currency bias or neutral, and 20% of the time looking at a long currency bias. And the scores are obviously more extreme in the short currency bias versus long currency bias. So when we look at the extreme cases here, we have extreme short, and we only have one case or two cases of extreme long, where we have much more extreme cases of shorts. Throughout history, what you're going to see is stimulus when economic crises occur. And that's obviously designed to counter deflationary conditions by causing inflationary pressures. The more deflation that occurs, the more conviction we're going to have that it will be dealt with by the authorities, or at least an attempt to deal with it, which can cause a very big shift in sentiment very quickly in the currency markets. In the opposite, we have a fall in conviction when significant inflationary pressures occur. This is because when inflation gets out of control, it's more than likely that future policy will be to tighten. So we may then enter a deflationary period, and we must be prepared to actually switch from here very quickly to a long bias, possibly here. So why don't we now apply this scorecard to our CPI stats and have a look at the latest numbers. If we look at the last 12 months and take an average, so we take a similar approach to previous analysis, we look at the last 12 months and we just work out the average level. We can see that in the last 12 months, the average monthly price change in CPI has actually been a negative, which is not surprising, seeing as though oil prices have been hit so hard in the last 7 months. Also in the last 6 months, there's been 4 deflationary months of between minus 0.02885% and minus 0.0787%, which is quite a high magnitude of deflation. Now, if we scorecard this overall, what we've got here is a situation where we're looking at around here on the scale. So when we look at the CPI numbers, we look at the latest one and we look for the biggest numbers that are contributing to this number over the last 12 months. And we just analyze this on a rolling 12-month basis. And this basically gives us, so minus 0.0156, this gives us a scorecard of this row here of minus 6. So we're looking here at CPI all items contributing a deflationary number to our overall scorecard analysis within the endogenous driver analysis. So obviously this is a pretty deflationary number. It's fairly significant. Now we can move on to CPI and exclude food and energy.